built a house in 2000 custom?
We built a custom home in 2005.
Amazing. Let's talk about it.
The builder built it and then sold it to us, but we got the custom.
Love it. All right. We're here.
All right. Hello, everyone, and welcome to the Lending Podcast, another episode. We are your hosts. This is Jeff Jones.
Hello.
I'm John Burnham. We are glad to be with you again today. What are we going to talk about, Jeff?
We are talking about land and building your dream home. And sometimes we're going to be talking about building your home, a custom home on land that you already own or land that you're about to purchase. A little bit, two different scenarios there.
That's right. A lot of folks that we're talking to are aspiring construction home builders at heart and want to build their own custom home. And so most of our clients that we discuss this scenario with have not bought the land yet, right? So you're looking for land. We want to build. We're going to talk about that and really dive in. And then we have a lot of clients that actually own a piece of land. They bought one maybe a year or two ago and had the goals of building, and things happened. And maybe they put it on pause, and now they're ready to pick it back up again. And so we're going to really dive into what type of financing do you need? How do you qualify for a construction loan? What is it about a construction loan that makes it different than regular financing? And also, what about a lot loan or a land loan makes it different, than a regular financing? And that actually came up the other day. I had a client that they're buying a house, putting 3% down, and they're looking for different homes. They could not find the home that they wanted, so then they wanted to. We're going to build. They decided, let's build. And so as we started talking about the financing, I said, well, wait. You're not able to put 3% down on a lot loan. It's a lot more down payment. So have you kind of come into that as well?
Yeah, and I think that that's a perfect term. It's a lot more down payment. It's my dad joke for the day.
That's pretty good.
But yeah, I think that the misunderstanding of how much down on just vacant land, it is not a home.
That's right.
So there's no property on it. When the tax appraisal looks at it, it's undeveloped.
That's right.
Right? So unimproved land, and it may have a little easement, it may have a little bit of electricity, but it's not ready to build.
Right.
So
and the goal is usually to get acreage, right? So it's an acre or 2 or 5 or 10 or however many acres. And so what we're usually having the conversation with the client up front about is how to actually secure the land financing. So let's talk about that first.
Yeah.
And then we can come back to, if you already own a piece of property, how does that play into your construction process? So land loans are typically 20% down.
And there's a reason for that, right?
Yes.
So why can't I just put 3% down on a lot like I could on a house?
That's a good question. Well, most of the time our land loans are going through community banks or private lending institutions, and it's a higher risk for the bank, because if you think about it, the buyer pool for a lot or a land loan is a lot smaller than the buyer pool for a home that has a lot that has an existing house on it, right? A resale home, as we say. And so the bank is looking at this piece of property, like you said, undeveloped. There's no structure on it. It is raw land. Sometimes the utilities are in, sometimes they're not. Sometimes it has water to the property, sometimes it doesn't. So depending on the type of property, it's a higher risk, and so they ask for more down payment.
Right. So it's almost always 20%.
That's
minimum.
right. That's right.
Good.
So let's kind of run through the scenario where we have a client who finds a lot. Let's say it's a $100,000 piece of property, and they want a loan on the lot. So that's 20% down is going to be $20,000. So we're going to finance $80,000 in that instance. Okay. Now, once we've secured the land loan, those take on average about 25 to 30 days to close. It's just like you would go through the process of buying a home. You need an appraisal. You don't really need insurance because there's no structure on the property, but you do have to get the title work done. You do have to get the appraisal done. And then we get the loan through underwriting and we get it approved and get it closed. And so now that you've got your land loan, you're making payments on that land loan on a monthly basis. Interest rates are usually around the prime rate. So prime rate.
So similar to what you see for a home rate.
That's right. Very similar. Might be a little more. Sometimes the terms are shorter. So you might have a 15-year term or a 20-year term on a lot loan, because the goal really is you're going to have this loan for a very short amount of time.
Right.
And the reason those lot loans aren't really a 30-year fixed or forever is because typically a buyer wants to build on that, right? So if we're transitioning to the construction process, the construction loan is going to pay off the land loan when you close on the interim construction financing. So let's break down kind of how that works with the construction piece. So you've bought the land, okay, and now you're working with your architect, you're working with your builder, you're going through the plans and specs and cost breakdowns, and now you've formulated and identified that budget and really honed in on, okay, this is what it's going to take to build the house. This is how much it's going to be. And typically we see the cost of construction on average is about 4 times the value of the lot. So if you have a $100,000 lot, you're probably putting about a $400,000 approximate construction loan on that house. Now it could be 300, it could be 500, it could be a million. Depends on the
Right.
lot and how you acquired that and the deal you got on that land, right? But usually it's about 4 to 1. We see 3 to 4 to 1 structure cost versus lot cost.
Okay.
Okay. And so the construction loan itself, we're looking at lending you 85% of the cost. So it's not even 20% down technically on the construction, it's only 85%. Sometimes 20% down, depending on the profile of the borrower, maybe the debt to income ratios, maybe the credit's good but not excellent. But for a really strong borrower, we're going to do 15% down. And we're doing 15% down on that construction loan because when we close on the construction loan, we're paying off that lot loan. And the lot loan has some equity. Remember, it had $20,000 down. So that $20,000 of equity applies toward the total cost, the total project cost of the construction loan.
So your total loan to value once you close on the construction loan is going to be less than 80.
It could be.
Right.
Yes.
That's the goal.
In some cases, yeah.
Right.
And so I like to put it to numbers. So hopefully everybody can kind of follow this. But let's just say the construction cost is $400,000. Okay. So you get your bid from your builder. You've done your architectural plan specs, elevations. You've got everything dialed in on paper, and it's 400 grand. Okay. You bought the land for 100. So 100 plus 400 is a 500,000 total project cost. Okay. Now, 20 grand is already in for down payment from the lot, and you need 15% down of the 500.
Right.
So you need $75,000 down technically on that $500,000 total project build
Good.
cost. Okay.
Yep.
Land
Tracking.
plus construction. So 20,000 is already in. So 75,000 minus 20, you're bringing another 55,000 to the table approximately plus closing costs, which are maybe 1 to 2% of the loan. You're bringing about 55,000 more plus closing costs to close on that construction loan.
Mm-hmm.
Okay. The construction loan pays off the land loan.
Right.
So now you don't have the land payment anymore.
One payment.
You have one payment. And typically these are interest only loans. And let's just say they're on average about 12 months long, right? Because the builder or the bank would like to see the builder complete that build in about 12 months. Larger homes may take 18 to 24 months. It depends on a lot of factors. Obviously, that's set up with the bank when we do the construction loan.
So to say that again, construction loans many times have the option to be interest only.
That's right.
Okay.
That's right.
For the first year.
That's right. Well, because if you think about it,
during the build process.
During the build process, exactly, because a lot of our clients have an existing house, they have a payment, or they have a rent payment if they don't own right now. And so they're paying the construction payment plus their rent or their mortgage payment.
Right.
So the bank wants to keep those payments down for you. So you're not just exhausting a ton of cash on a monthly basis.
Yeah, that's great.
So the interest only helps keep those payments down. And it's also a stair-stepped payment throughout the construction process. So let's say it's a 9-month build. Okay. And we've got this 1-year interest only loan in case the construction goes a little long. And there's a lot of reasons why it may take a little longer. We won't get into that. It is common. And so the first draw, when you close on that construction loan, it pays off that $80,000 balance on that land loan. And it also may give the builder an initial draw, or maybe we're paying the architect for the plans. We're paying some soft costs, as we call them, some of the costs that you incurred prior to closing on the loan. And so as the builder completes certain milestones, foundation, framing, roof, etc., and then all the interior work, every time the builder hits a milestone, the bank is going to send a wire or a draw, what we call, to the builder for, let's just say they're $50,000 each, and we do that 9 times, right, or 8 times to get $400,000. So each time that draw comes out from the bank to the builder, it will increase the balance that the borrower owes to the bank, and therefore increase that payment as as it goes through the build process.
Good.
But the buyer's only paying on what's been drawn down from the bank,
Perfect.
which keeps that payment relatively low until the last few months before, right when the homes are almost complete, and then you've got $400,000 or $500,000 loan out there, and you're paying pretty much full payments on that.
Yeah. I mean, that is such a different scenario than just a basic mortgage, right? So, a draw loan that is only being paid interest on what was drawn at that time.
That's right.
So, what's amazing is you're really, when you're working with your builder, he's going to only get paid when he completes a milestone,
Yes.
right? And some of those milestones have inspectors to verify.
Each milestone, yeah, good point. Each of those milestones is going to have an
Right.
inspection that the bank is going to order, and those inspections are prepaid up front. That's part of the closing costs of the
Yep.
construction loan. So let's just say there's 8 different inspection time periods, or one a month
Mhm.
for sake of argument. Then each time the inspector goes out there, they're basically blessing that
Right.
what the builder said they've done. They report back to the bank. The bank says, okay, we'll send the
Right.
builder the money. And so the builder continues to pay his subs and pay for materials
Yeah.
as
And
the
I love
build.
that check and balance just because, a lot of people, especially if they've never done a build before, they're not a licensed contractor in their past. They don't know how to handle subcontractors. The bank is really there kind of helping as a safeguard, and the inspectors really have your back
Absolutely.
as the owner of that property, because they don't want to give money to a builder that didn't complete what he said he completed. So I think that is just a great safeguard to have a construction loan help you out with that.
For sure. And so the other option, what we see sometimes, is if a client already owns the land. So let's dive
Yeah,
into that real
good.
quick. So that was a scenario where you buy the land and you build pretty close together. Now let's say you've owned your piece of property for a year or two. Well, the nice thing about having a property for at least 12 months is now we're going to use the appraisal value of that land as equity towards your build
Instead of the purchase value.
instead of the purchase value.
Okay.
And so let's use those same numbers and say that it's been 2 years since you bought the lot. You paid $100,000 for the lot. Now it's worth $150,000. Well, $150,000 value, and you financed $80,000. Maybe you've paid that balance down a little bit. Let's say you owe 75 grand. Well, you now have 75,000 in equity.
Instead of 20 grand.
And lo and
Right.
behold, you need 75,000 for the build. You don't have to come out of pocket with cash. You're actually coming with the equity in your land, pledging that land, of course, with as collateral for the build, because the property structure is going to be built on your property, and you have 75,000 in equity on it. Now that equity is essentially your down payment. So it's
Wow.
possible, depending on the value of the land, to come out of pocket with very, very minimal amount of dollars, maybe 5, 10 grand,
Plus
20
only paying
grand.
interest only while it's getting built.
Exactly. And
That's
so
great.
so that's what we see a lot of times, especially in the greater Austin area, Central Texas. We've seen those land values go up.
Absolutely.
We have clients that have been holding on to a piece of land. They aren't really sure what to do with it. And maybe it is the right decision to sell it and go do something else, take the equity and parlay that into another purchase for sure. But if you're considering building, that equity position may get you in a place where you don't even have to come out of pocket with a lot of
After you buy
money
the
for a
land.
down payment. That's
Right.
right. If you've already owned the land.
Right.
Yeah,
So that year mark is kind of a critical time frame.
it is.
So especially if it appraises for even more,
That's
like
right.
maybe appraises for 300 because it's been a developed area. We
That's
just
right.
don't know that. So getting a piece of land right even today or right now could be great. Just and
Yes.
sit on it for a year or make your plans for a year because sometimes it takes a year for you to figure out, your drawings, your layout of your house, the fun part of like going to builders and talking to them and walking through the property, seeing what a finished product looks like, shopping basically, right?
Absolutely. It could take, I mean,
So,
it could take a year or two to design a house. And then, of
right,
course, you could do it a lot faster than that if you already know pretty much what you want.
right.
Now, let's talk about structure types real quick. So, we get this question a lot, and we have converted barns here in Central Texas and all over
Barn
Texas called
dominiums.
barn dominiums, right? So, barn dominiums are amazing. I've seen some of the
Yeah,
most
they're
tricked
sweet.
out barn dominiums you can imagine. And sometimes they're pretty basic, 40 by 80 structures, which
Right.
is 3,200 square feet, right? 40 feet by 80 feet. And so almost 3,000 or more than 3,000 square feet on these converted and finished out barns. And so is that an acceptable property type? Absolutely. We can do barn dominiums.
Because it has living quarters.
That's right. It has living quarters, kitchen, bedrooms, all the things. And so we have to make sure it's livable. It has to have plumbing. It has to have all the things. It can't
Right.
just be, a barn that you're just keeping your horses in. But
Right.
yeah, it has to be livable. And then that is considered a single family dwelling at the end of the construction. So then we can put it into permanent financing. So depending on your specific situation, what kind of property you're building, what kind of structure, all the amenities of that property will determine what kind of permanent financing that you need after the construction's built. So we always get the question, what happens when the construction's finished,
Right.
right? Well, it's essentially a refinance because
Right.
you've bought the land, you've built the home, it's in your name. This is assuming the
Hmm.
construction loan's in your name. There are other kinds of custom builds where the builder may have the loan in their name, and that's maybe a different scenario we're not really talking about on this episode. But you own the property, you've built the home, you've obtained the construction loan, you've made those payments. Now the home's complete and you're putting it into a permanent loan. That process is essentially a refinance. Now, the cool part about refinancing those construction loans is we're going to appraise the finished product. So the finished home, it doesn't matter how long it took to build, a year,
Right.
2 years, what have you. We're looking at the comparable sales and the value of the properties around this custom build that you just completed. And we're giving you the equity position for that refinance that you've earned as some sweat equity, let's face it, because building a house is definitely going to involve some of your work too, not just the builder.
Right.
It takes a lot to complete these construction projects. And that equity position is going to put you in more favorable permanent financing terms. And you might have 30, 40, 50% equity, and maybe not quite that much, but that's going to be a construction to perm.
Hmm.
And you hear about that out there in the marketplace.
Yeah, and I think that you alluded to something about, there's a value of the land and then the value of the structures, right? And so even if you look at a county appraisal, they'll have those broken out too. But the end total of that is really your equity spot.
Yes, yes. And then we're going to hire that independent third party appraiser,
Right.
look at the value. And sometimes it's challenging for appraisers, especially if a property is in a more rural area or if you have a lot of acreage. There may not be a lot of properties just like yours. So they
Right.
really have to go maybe 10, 15, 20 miles out. They've got to go back more than a year. Traditional appraisals, we're looking at properties that have sold in the last 6 months, and we're looking at roughly a mile radius. That's
Right.
what, and we're staying within a certain neighborhood for the most part. Well, that's tougher on some of these custom builds that might be further out or have a
Yeah.
lot of acreage. So the appraisal process for a custom build construction to perm loan requires a very skilled appraiser and someone, like on our panel, they've all been vetted by our company. They've all have years and
Right.
years of experience, and they have a lot of knowledge of the market, and they're very resourceful, and they're looking at all the different amenities of the property to compare it with similar properties, as similar as they can find, although they may really have to stretch and try to find those values, because the refinance value, the appraisal value on that refinance is going to help give you better terms. The more
Right.
equity you have, potentially the better permanent loan you're going to get, because the bank looks at that as lower risk if you have more equity, right?
Right.
When you have more equity.
And as we talk about structures, I have a person who installed my water in my house for the salt filtration system, and he's showing pictures of his custom build on his home, and it was an earthen home.
Oh, yes.
So he was building it almost like, Hobbiton, so it's got these dome looks to it. He's putting different mud structures together around tires. It looks beautiful, beautiful scenario. It's got a grass roof.
That's what we
It's
call a
amazing.
unique property.
So an appraisal on that won't come to what you're hoping that it's going to be valued at, right?
Potentially.
That might just be a land appraisal at that point.
It,
So there's a certain amount of customizations when it goes outside of anything that can be comparable. So, is that a scenario that can get a construction loan or no?
So for sure, I mean, it depends on the bank. It
Depends on
depends
the
on the
bank.
bank's appetite
Okay.
for that type of financing. It also could depend on the strength of the borrower, the cash reserves.
Yeah.
Banks on these construction loans are really looking at what is going to happen if we have to take over this property, right?
Yeah.
And they don't want to have to take over. Banks are not in the real estate industry; they're in the lending industry, right? They don't want the property back.
Yeah.
And so the other thing too about a property like that is as buyers and sellers, we get so excited about unique properties,
Yeah,
right? Our favorite two words as a buyer, we found this property, it's so unique, it has all these characteristics that we love. And as a seller, we talk about our own houses and how unique they are and the things that we've done to make them special and make them livable for us, the things that we love about the house. And those two words that buyers and sellers love, unique property, are the two words that banks really don't like.
absolutely.
Unique properties, because they want every property to look like everybody else's so they can easily value it. And if they had to take the property
Right.
back, they believe it is highly marketable and they're not going to be sitting on a house that's so unique. The buyer pool is really small.
And there's some good reasons of why there's a hesitancy to unique houses with financing, just because we need adequate comparables. And when it's so unique, it's hard to put a percentage of like how that uniqueness affects the value.
That's right.
So it's a numbers game on that one. There is other structures that are we get questions about. I get questions about what if I buy land and I put a trailer on it while I'm like planning the build? Can you help finance the trailer? Since it's not, basically it's a recreational vehicle.
It's personal
So it's
property, right?
personal
It's not.
property instead of, we're going to use a term here called real property.
Right.
Right. So personal property, it can be moved off the property. So that's the risk, is we can't finance something that can easily just be carted away.
That's right. And that personal loan, if you will, that personal property can be financed through a bank. It may not be a mortgage company, right? That's
Right.
doing because we're doing mortgage loans on real property.
Right.
A movable trailer is going to be personal property, considered personal property. So that may be a financing through
Wherever you're getting the
the
trailer from,
manufactured
might
home.
just finance
Yes.
it.
Or a tiny home,
Tiny home.
or some of those prefabbed homes. They've got some really cool options out there to actually live on your
Yeah.
property while the build's going on. And it's a really great way to do it because you're on site and you're kind of
Right.
overseeing the project, right?
And manufactured homes are a little bit different animal. They're single wides, which have a very limited scope of financing than the double wides, which is our bigger footprints, have a better scope of financing. And those always need to have a slab that they're anchored to, and then they're skirting around it to finish it off so it can never be moved again.
That's right.
And there's additional inspections for that, just to
Yes.
verify the engineering is good.
Yes, and to come back also to the different types of construction loans, there's also something in the industry called one-time close. You hear about a
Ooh,
one-time
I like that.
close. And so what we really talked about, was a three-time close. You're buying land, you're getting a construction loan, you're getting a permanent loan. It's almost three different transactions.
Okay.
But we kind of consider that land and construction sort of the first half of it. So most cases you call that a two-time close, right? But there's actually three different closings if you're buying land, doing the construction, and then getting your permanent loan. So let's talk about a one-time close. So a one-time close is a really cool product out there because it will allow a buyer to qualify for the permanent financing a year in advance. So we all know in the industry, when you're building a custom home, the end result is you're going to need a permanent, in most cases, 30-year fixed.
Right.
Maybe it's a 20-year or a 15-year, sure. But you're qualifying for the 30-year fixed. Can the mortgage company approve you for a 30-year fixed loan? That's what the construction lender wants to know.
Good.
And so that's using two different banks where the construction loan on a two-time close, let's say, is relying on the qualifications and the approval of the end mortgage company approving the permanent financing.
Right.
So there's some risk involved, right? The borrower's job status could change, income status could change, credit status could change. So there are some risks throughout the construction process that could affect your ability to get a permanent loan. And so the one-time close allows you to qualify for the permanent financing up front, get the construction loan. When it comes time to roll into the permanent financing, you're not re-qualifying for the loan.
Nice.
So there may be some updated job employment verifications and things like that, but you're not actually re-qualifying and reapplying for a mortgage. So it's a very appealing product. Most of the time we see those one-time close on jumbo loans, which are anything for the most part over $1 million, over about 800,000 or more. And so we do offer a one-time close product. Most of the time, the two-time close offers more flexibility.
Right.
When we offer both products to our clients, a lot of our clients gravitate to the two-time close because If you're making changes throughout the process to the build, it's a lot easier actually to change and modify the construction loan
Yeah.
than it is to change and modify that one-time
Right.
close loan that you've already closed on. Maybe it's a $2 million loan
Right.
and you're trying to make some change orders for a couple hundred grand. It's really challenging. So that comes back to every situation's unique. We're going to look at what's best for you. We're going to evaluate the two-time close. We're going to look at the construction and the perm separately. We're going to look at that product together if you're qualified for that product and see which one's going to fit best.
Yeah. No, that's amazing. And so to kind of recap for people that haven't done this yet, and this is your first time hearing about how this all works, it might be doable for you. So it's great to talk to your lending specialists and see what your scenario is going to be. So a conversation is the best way to start with your lender to see what possibilities are out there for you. I love the concept of like if you get a lot now and then you build on it and it's interest only while you're still living in your home, that could be a very doable payment system for you, and you could still get the house of your dreams. So,
That's right. And that's a good point because a lot of our clients don't realize that payment on the construction loan is so much lower than you think
oh,
it might be.
absolutely.
It's not going to be a $4,000 or $5,000 a
Right.
month payment until the home is finished,
Yeah.
depending on your loan amount. It might only be a couple grand or even less than what you're paying in rent to start off. And so you graduate into that uh, as the construction process
Yeah.
is completed. So it's an interesting time right now. There's a lot of folks that we're talking to that do want some elbow room, so to speak. You want some land, you've got pets, or you want to raise chickens or whatever it is, and you want that 2, 3, 5 acres. I
You
talked
want
to a guy
no
yesterday.
HOA, you want
I
acreage.
know. I have
Right.
a client I talked to yesterday. They have 7 dogs. I thought, yeah, he does have 5 acres, so he's got
That's
plenty of
good.
space. But that's really what we're seeing a lot of. So I
Right.
hope this helps, and we're here for you guys if you have questions.
Yeah, wonderful. I love this episode. I learn a lot every time I hear you talk about land and construction. But this is the Lending Podcast with JB and myself. Thank you so much for tuning in. Like, subscribe, and please share. We love getting word out there for good information so people can make good decisions. And thank you so much.
That's right. Thanks so much. Talk to you soon.